investing.
Welcome back to Good Morning San Diego. The time now is 7:19. The AI boom is getting increasingly dependent on financing. So that begs the question, how much of the growth is being driven by genuine economic demand? To answer that and more, we are joined by Vice President of Wilsey Asset Management, Mr. Chase Wilsey, who makes a regular stop here. Sir, good morning to you.
Good morning.
All right, so for a time there, a few months back, all it was anything AI related was just on a steep ride to the top of the hill. NVIDIA and companies like that. We're starting to see a little backing up, are we not?
A little bit of backing up. I mean, we kind of had the failure of situational awareness, which is a hedge fund there. Kind of, I'd say, created a pause in that AI boom in terms of the stock prices. I mean, we've recovered a little bit since then, but we're nowhere near kind of the peaks on the memory, like Micron, SanDisk, you know, companies like that. We're still off the highs for businesses.
So what is that? The venture capital money, does that mean it dried up, or what happened that this is happening?
I'd say the big reason that we kind of saw this decline was there was an immense amount of leverage in the market, which we've talked about before, and I think people started to have to kind of cover that leverage position. So now the only way to really get it back up is you got to either attract new investors or you have to see leverage ramp back up again to where we were back in, you know, July, before the big bust happened in situational awareness. So I think, again, the unwinding of leverage is really kind of a microcosm of what could happen on a bigger scale if things kind of unwind.
So that's bad news for the people that are maybe over their skis a little bit much. But is it good news for the overall health of the market?
You know, the hard part when you look at the market, I mean, the S&P 500 is a market cap weighted index, right? So it's really tilted so heavily towards your NVIDIAs, towards your Apples, your Amazons, your Microsofts, your tech companies like that. I believe the Mag 7 now accounts for about a third of the market, we'll say. So when you look at the S&P 500, it's not really as broad-based as many people think. And that's a big concern I have. If you look at like the equal weight S&P 500, that's where you assign an equal weighting to each individual company in the S&P 500. That's actually outperformed the S&P 500 market cap weighted year to date, and I think that'll continue because the overall economy and the overall market, I believe, remains on good footing, but a lot of that tech trade, there's a lot of concerns that can still kind of pop up.
Well, if you listen to Elon Musk, AI is going to change the world very quickly. In fact, a lot of people would say it already has. Why then is it not a good bet to continue to invest in those companies?
I have a lot of concern. I talk about the leverage from the investing side, but there's also now a lot of leverage that's really starting to pop up from the AI companies themselves. I mean, we saw last week there was a deal between kind of NVIDIA, KKR, Apollo, a lot of like Goldman Sachs, these financiers saying, okay, maybe we'll come together and do an asset-based loan product for around $500 billion of new capital. We're seeing a lot of these kind of weird financing deals pop up. We've seen people issue kind of like revenue deals where I'll buy your chips and we'll give you stock warrants, which means we'll give you a deal to buy your stock. So we're seeing these weird financing deals that, again, make me a little bit concerned of how genuine is that economic demand for the next 3, 5, 10 years.
Those weird, I think of the LA Dodgers when you're talking about weird financing.
Yeah.
I mean, that's like the pinnacle of. So then what's the smart play then as we wrap this up? What's your advice to people?
You know, I mean, I talk a lot about the tech bust. I don't think it's going to be exactly like the tech bust, but a lot of people look back at, you know, the 2000 to 2002 era and say, oh my gosh, you know, the stock market was so crazy. There was actually a lot of things that did fine during the tech bust, like healthcare, like food companies, like insurance businesses. That's, again, where I'm still fixating because there's not as heavy of a valuation premium on businesses like that. It didn't go through that momentum craziness. So I think there's a lot of great opportunities outside of tech, and that's where most of my money and most of my clients' money is in our portfolios.
Chase, we'll call it a conversation on that note, okay?
All right, thank you.
Have a good rest of your day. There is much more coming your way on Good Morning San Diego, including a push for one.